Good evening. This is Doc Severson for the TheoTrade report for Tuesday, November 7th. Well, I suppose it's about time. I'm going to go ahead and call it. I'm going to call this Euphoria. Yeah, it's surprising, right? So for those of you that don't know, there's 4 phases to any market rally, regardless of what time frame it's in. I see this intraday as well as on the monthly chart. We can see that phase 1 usually starts after Euphoria and it leads to disgust. So disgust is where we run into markets selling off and people are disgusted. They can't even stand to look at their broker statement when it comes in the mail. Followed by that comes disbelief. This is where we just can't believe it. There's a rally coming up, and this always comes from the point of maximum bearishness. This is where you cannot find any positive articles in the market whatsoever. And I'm going to extend this out to periods in 2010, 2011, as well as some periods here in 2015, 2016, as these were all severe corrections. Okay, so from that disgust, you get disbelief, and then, eventually disbelief even on these rallies as well, too. Disbelief, and the most recent disbelief that I think that we experienced was really right after Brexit. So that was about a year and a half ago, late June 2016. We couldn't believe the market had just completely exploded higher out of a very, very large range on unexpected news. And that has really led to this uninterrupted rally that we've had. So we go from disgust to disbelief to the third period, which is acceptance. So acceptance usually comes where we get into kind of a thicker area, sort of a more choppy area where people knowingly nod at each other and say, yep, I suppose the market's going higher at this point. So we've gotten rid of the disbelief. People have gotten over the fact that the market has rallied off the bottom. They're no longer looking over their shoulders like they were before during the disbelief phase, thinking that it was just going to collapse at any moment, right? So you can also see this a little bit better on this particular rally. So this is where we got into our, we were in the disgust phase here back last January and February of 2016. We got into disbelief. And at this point, this is where we, especially after the election last year, which is exactly 1 year ago today, this is where we've gotten into kind of the acceptance foot. Now, what you'll also see, though, is if we look at this on the S&P 500, this is fairly linear. And what we've seen is that just recently, out of this most recent breakout, after around the end of August, early September, the market has taken on a different slope. You can see that there's a lot more urgency towards this. And a lot of this has to do with money rotating back into tech again. So if we go out to our custom indicator out here, which has got Facebook, Apple, Microsoft, Google, and Amazon, you can see that a lot of this is where money rotated back into big cap tech. And this is right after the most recent earnings, which blew everybody's expectations away. So all this money is going back into Amazon and Facebook and Apple and Intel even, as well as NVIDIA and Microsoft. And no matter where I go on the financial websites, everybody is now posting articles on why this bull market could probably continue for much, much longer. Now, ultimately, from a secular perspective, let's go back to the S&P 500 here. From a secular perspective, I think that the S&P is not done yet. So I don't buy into the theory that we're going to be seeing, any day now we're going to be seeing a 50% haircut just show up out of nowhere. I don't buy into that theory right now, because if you look back on history, every single market top, every single one, without exception, if you go back 100 years, you will not see any difference in every market top. Every single one of them has been marked by an increase in historical volatility or realized volatility, whichever way you want to say it. So what we're going to see at some point here is that we will start to, it usually starts with what I call the shot over the bow. The shot over the bow is kind of the warning shot to say, look out, you might want to get out of the market if you're too long, or if you just don't have good risk controls. But this is typically where we start to see increased volatility. Now, don't forget, this is one thing a lot of people forget right now. Everybody is used to thinking in terms of relative numbers like, wow, 100 points is a huge day in the S&P. Well, that might have been the case when the S&P was down here around 1,000. 100 points was 10% of the S&P, and that got your attention, especially during the financial crisis. This is why it was so devastating, because we're losing 10% on a daily basis back then. But 10% is a 260-point move. Up here, right, up at 2,600, 10% is a 260-point move. So we could have 100 handles, and that's going to be not even make a dent in things. So because of the fact on percentage basis, we can expect to see larger moves up at these levels. But just because we see larger moves does not necessarily mean that we're going to see the end of the world. I do believe that we're going to see some volatility coming into the market, because we have never seen a condition where we've had this low of a level on the monthly chart without some type of corrective action. It just will happen. There's going to be some piece of news, some exogenous event will come into the market, which is not priced in there, and it will cause that shift into larger volatility. So I do believe we are getting closer to that, because we are getting into the euphoria phase here. Now, the next caveat that I have, though, is because we're in the euphoria phase, this is quite often where some of the most dramatic gains come. And this is exactly the opposite of what you see to the downside, right? The worst selling comes at the very end of a bear. The worst selling always comes at the end of a bear. The strongest buying always comes at the very end of a move. And if you have any doubts about that, go take a look at what happened back at silver back in 2010. So from this strong base and ascending wedge here, we had the move get stronger and stronger. And you'll notice that the biggest green candle here is the very last one. So euphoria does not necessarily have any limits. So today I'm calling the beginning of euphoria, but I don't know where it's going to end. And it's a bit of a fool's errand to try to time this. So just to corroborate this, we have evidence everywhere for this, mostly divergences everywhere we look. And they're not quite the same divergences that perhaps you're used to thinking, such as a MACD histogram divergence, things like that. Those have been going on forever, right? But it's ones like this where we see the number of stocks above the 200-day moving average, in this case a percentage of the Nasdaq 100 stocks above the 200-day moving average, is now down in the 60s. So what that means is that 35% of stocks are below the 200-day moving average. A 200-day moving average is sort of a proxy for the delineation between an uptrend and a downtrend. It's not completely and totally accurate, but it's good enough to give us a dart toss, and pretty good in terms of whether a stock is above or below the 200-day moving average, whether it's trending up or down. And so how can we be at all-time highs on the Nasdaq where you're not supporting it through the entire index? And the reason is because we just keep pushing money towards the winners. We just keep pushing money towards the same bunch of stocks, which are generally the Facebooks, the Apples, the Microsoft, Google, Amazon. As we look over at the Dow, we continue to see money coming in, of course, on Apple, but also Boeing and Caterpillar and now Disney. And, you know, some of the same ones that we've seen for a long time. So the same usual suspects. But the problem with this is you almost get to a point where you're balancing everything. You're balancing an extremely heavy weight on top of a long, skinny pole like this. And you can continue to do this. You can continue to pile money into just these big heavyweights as the musical chairs market keeps on going like this. But don't shake the pole, right? Don't add any instability on here, because the single, it's a single fly lands on top of this thing can throw the weight balance off. And all of a sudden, this is where you'll see it happened. And if you want an example of that, just go back to 2015 again. So 2015, back in the S&P 500, August of 24th, you can see that this is where we had that exact same thing going on. But you'll also notice that 2013, 2014 was very similar to the type of market that we have right now. It was persistent. It just kept on going. Now, the thing that is different from this market versus 2013 is that we got these regular little pullbacks. So these regular little breaks that occurred in here, very similar to the market rally that we saw back in 2006, 2007, very, very similar to that. But all these little pullbacks allow the chart to recharge when it has to. Range expansion goes to range contraction, it recharges, and it blows up again. But this was part of the tell here, is that we got very, very quiet in 2015. Range contraction to an extreme led to range expansion finally. Now, this doesn't look like that big of a move when you look in the rearview mirror. You know, you just see that and you go, oh, well, that was just a garden variety pullback. No, it wasn't. That was pretty serious. We dropped 200 points. That was a good 10 to 12%, I believe, in just a couple of days. So this was very quick, very rapid. But as you'll see, this is the same formula that we've seen throughout the decades and the centuries, is that for the market to go higher, it needs to occasionally take a step back. And this is what I believe will occur next. Maybe not the same quite amplitude as this one. I don't think we quite need that but simply pulling back, going into we'll get that shot over the bow. We will go into a larger range fairly soon. But again, my caveat is that the euphoria phase can actually go further and higher than people would believe possible. So the question is then, how do you trade this tape? What do you do with something like this? Well, don't fight the tape, first of all. Don't fight the tape. Take it long, but make sure your risk is managed well. Don't be selling puts on stocks with prices up here at all-time highs. Don't be doing things like that. Go towards limited risk instruments where we do things like the in-out spreads, where we define the risk on the trade. If it doesn't work, if the price craters from there, we've already set our risk from day one on the trade. We don't have to lose any sleep overnight on things like that. So really the key is limited risk, number one. Number two is limited hold time. Limited risk, limited hold time. You want to get in, get your fair share, and get out, because the longer that you hold a position in today's market, the more susceptible that you are to that initial shot over the bow and that changing character towards a corrective market. That is it for tonight's report. Thanks for listening, folks. We'll see you tomorrow.